Hi, everyone. Welcome to another episode of 10,000 Roads to Financial Independence. Today, we have Will Coleman with us from Rand Capital. And Will, at age 26, is a partner of Rand Capital, which focuses on providing mortgage solutions for multifamily, commercial multifamily properties. So very glad to have him on the show today and just kind of really explore how he exponentially kind of personal growth and as well as become an entrepreneur at such a young age. Welcome, Will.
Yeah. How's it going? Happy to be here.
Definitely. Well, we're gonna always start our show with this typical question on who do you think back in your childhood or incidents in your childhood that gives you the most impact for you to become the entrepreneur who you are today and essentially living the not so norm lifestyle. Yeah.
So the probably my ego would answer that question of saying that it was just bred in me, that it was just who I was. But probably subconsciously it came through my father. He at the age of 27 started his own insurance brokerage. So he and he's done that for the past 35 years. So as a kid, I would go to his office and kind of see him as the boss and not really understand what was going on. But as I got older, I could understand that he's running his own company. And so I probably subconsciously, I got my entrepreneurial spirit from my father, but I've always had that.
Yeah.
Even as a little kid, I was thinking about how I was going to start a business and thinking of ideas and so that it's a combination of I got it from my father, but also is like it's definitely inbred of who part of who I am.
Yeah. So do you have like some interesting childhood entrepreneur story to share? Yes, can
That
you
could be a
share?
whole podcast.
Yeah, yeah. Like tell us a little bit more about, let's just say like your first venture or the one that gives you the most impression, um, you know,
Uh,
on that.
so probably my first like real business. I had a bunch of like small knickknack things where I would try and sell like I made candles. I would try and sell T-shirts that I had made. Try and like buy snacks wholesale and sell them. So, like the list, I promise you, goes on and on and on.
Yeah.
But the probably the first like legitimate one I had was a billboard company.
Oh, a
So I
billboard company?
a billboard company.
Oh,
Yep.
interesting.
So I in college I found a plot of land that was zoned for a billboard that had not had a billboard put on it yet, and I uh, got a contract with the landowner to build and put a billboard on it, and so I built the billboard, and then I had a contract with the roofing company to put the roofing company advertisement onto the billboard,
Mm.
and I did that, and it was an easy $200 a month, and in college that wasn't bad.
Yeah.
And, turns out there's not a lot of land like that that's available. So after I got the first one, it was very difficult to find the next few. But that was like the first legal business, and that was in college that I got moving.
That's awesome. What did that first business like? How did you ended up finding the billboard company? Were you targeting it? What it like? What were you doing? Like, because you, like you said, they're very difficult to find. So it's not any days you walk down the street that you just be able to kind of find a land like that. So tell us
Yeah,
a little bit about the process.
I was always very fascinated with the idea of passive income. I did not want to. I think I've always been a very conscious individual, and so the I did not want to trade time for money. That has always been a very conscious thought, even since I was very young.
Mm.
And so the idea of passive income to me was a driving force, and so I was trying to focus my ideas around businesses that would lead to that. And just billboards seemed to be reasonable, where you could either go out and buy a dilapidated billboard or like one that had or find an area where you could build a billboard. So the finding the land came from the idea of like I can either go build a billboard or find one that's broken down and buy it from the owner.
Mm.
And I even was a contractor for a billboard company that I would search for land, and if I found land and gave it to them, that they would pay me a commission. And so there was numerous ideas tailored towards it, but once I kind of had the idea of finding the land, I would just go on the county website, and they have interactive maps that show the zoning. And so I would just scavenge the county websites until I found the right plot of land.
Nice, nice. So it was really intended, like you set a goal on what you want to do. Like you kind of knew the billboards what you wanted to build, and then from there kind of figure out a way to kind of do it, which is very, very great lesson in that itself on how to kind of achieve things that you didn't know how to do.
Mhm.
So you mentioned about the passive idea was always in your head in the early stage even when you think about that, when is that? I guess because your dad's an entrepreneur, so it kind of gives a little bit more environment to foster that entrepreneur spirits. So maybe that's the norm for you. But when, because being an entrepreneur and have a passive income is a separate thing. So when
Mm.
did that like passive income idea kind of got in your head, and what was the transition, and what kind of that pivot point is? Um,
Yeah. I don't know if I could pinpoint a specific time, but it was definitely when I was probably 15 or 16 of just I I never liked the idea of a job. I don't really know why. I just always thought that I would be able to create something that would produce income rather than have to trade time for money. So I don't know if I could pinpoint a specific time frame, but the just I was always very like, how can I make money with doing little amounts of work?
that's awesome.
I probably that I was the same way in school. I was like, how can I get a B with doing the least amount of work possible?
Right, optimizing your time, right?
Yeah,
And you mentioned about the idea of job. So you went to college, but you ended up went to college and all that. Have you ever had a like a regular W-2 job?
yeah. I think my parents forced me to.
Yeah,
I would always say like my in college I say my goal is to not have a job. So I was trying to create this billboard company or find something that would pay for my expenses rather than getting a job. But
yeah,
um, our parents did kind of say that you should get a job because you can learn how people are managed. You can learn, there's a ton of learning lessons from getting a job. So I did, out of college, I got a W-2 job at a commercial real estate bank in Texas.
mhm.
And that's where kind of my love affair for debt began. Is I was an underwriter at a bank in Texas.
Gotcha. And if you give people recommendation on folks who wants to get into that, become a banker and this and that, not banker, but become a bank yourself eventually, um, then would you say that this is maybe a good path to take looking back? Do you feel like that job kind of really is giving you some fundamentals in terms of learning and knowledge to kind of set you up for success later on?
Absolutely, yeah. There, I think my parents gave very sage advice that getting a job and getting a job that is more of an educational experience rather than a compensation type experience
Yeah,
um, is very very helpful. Like I mean, I made okay money for my age at the bank, but it was definitely not an investment bank. It was it was an underwriter at just a small commercial real estate bank.
yeah,
Um, but the lessons learned and the understanding of the fundamentals of how a bank works and how the underwriting and the analysis works is, I mean, it's what's allowed me to get into this opportunity now and to speak confidently to people about debt and how money moves and how banks make decisions. So I think probably the best piece of advice, one of the best pieces of advice I've ever gotten was get a job that makes you a better investor. Or, whatever you want to do long term, your first job out of college, get a job that will make you better at that. And so again, I kind of had a conscious decision of whatever job I get, I want it to be something that will provide education that will allow me to be a better investor and understanding how debt works. and people can say whatever they want. I think debt is the most important piece of the economy. And
Right.
so understanding how that works is very vital.
Yeah, absolutely, absolutely. That's amazing. So for folks who are kind of interested in becoming a bank yourself, it may be a good idea to maybe starting from the bottom of the jobs where it is become an analyst of underwriting department, this and that, or potentially a mortgage broker who has access to this type of underwriting, but really kind of focus on the learning of the numbers from their end. That's awesome. So fast forward a little bit. So you got a job at a bank. You probably, what did you like about that job then? What did you not like about the job?
I really loved the work. People would ask me, "How do you like your job?" And I would say, like, I love it. Like I genuinely loved it. The
What
I
aspect of it mostly?
huh?
What
Yeah, yeah.
aspect of it mostly? Yeah.
So I think understanding your personality and then aligning a job that fits that personality is important. And I didn't necessarily understand this then, but I my personality is hinged around finding accuracy and finding truth.
Uh-huh.
And uh, an underwriter at a bank, that's all they're supposed to do. Is this a good loan or is this a bad loan? And find the accuracy of the numbers.
Yeah.
I was lucky enough where the job that I got aligned perfectly with my personality type, and it gave me energy. I was excited for someone to give me a bunch of documents and say, find the accuracy in all this. And
Yeah.
it made me very excited. Whereas most people, it would drive crazy.
Yeah.
They
Absolutely.
would
Absolutely.
hate
Yeah. Yeah. I can't imagine because I'm like the opposite personality
that.
over that. Yeah.
Um, so I really enjoyed taking a bunch of disorganized numbers and making them very organized in order to interpret an accurate number. And I was lucky to have great employees, or not employees, coworkers, and a great boss and great managers. Like the people at that bank were phenomenal. I still keep in touch with all of them.
Yeah.
The only thing I didn't like was it was 9 to 5. Like I didn't want to go home at 5 p.m. and I wanted to show up earlier than 9. I was not the standard employee. Like uh, at a bank, because they keep cash there, you can't be there by yourself.
Uh,
So late nights are not an option. Early mornings are not an option.
wow.
You can only walk in at 9 and you have to leave at 5.
Yeah.
Uh,
We
and
hear most complaints about people 9 to 5 is like that's too long and too rigid of a schedule, but it's the opposite with you where you actually want to be there longer and then do more work.
yeah, no, I'm a workhorse, that's for sure.
Yeah, that's amazing. Um, so moving forward from there, did you like get a promotion? Did you get to like sample different kind of career passes inside of the mortgage lending land before you kind of decided to move forward into a more independent entity yourself? Yeah.
Uh, yeah, I kind of was along the standard promotion path of like there's underwrite. So they called them credit analyst one, two, and three. So
Yeah.
I was climbing that ladder, and it really just involves handling larger, more complicated loans. So like in the from beginning, I was underwriting $50,000, $100,000 loans, and by the end of it, I was underwriting $8 to $20 million loans on very complex deals.
Yeah.
So that was really the promotion there, and then I was just kind of planning to climb that ladder, and then this opportunity came about, and you uh, you take opportunities when they come.
Yeah, definitely, definitely. So tell us about the transition out of kind of like your job into partnerships.
Mhm.
And how did that happen? Was the opportunity? Did you kind of seek out for it? Like how did it happen?
Yeah, so most people that know myself probably know Jake and Gino. So Jake and Gino are two great guys. They've created an education platform that teaches people how to buy, manage, and operate multifamily properties.
Mhm.
And I'd worked at the bank for just over a couple years, and I was buying single family in Texas, and I was wanting to start to buy multifamily, and I kind of realized that the group or my network was not at a high enough level that I could raise millions of dollars. So
Yeah.
I started researching, and I thought joining an education company would put me in the circle that I needed to be to raise more capital. And
Mm.
so I joined Jake and Gino as a student. I paid to join the education program. Shout out to Josh Rusin. He's a good guy. And so I met them as a student of theirs, and then me and Gino would keep in touch, and I would teach every now and again on bank financing, just because I understood how banks work, and
Right.
so they would have me present, and Jake and Gino had started to create a mortgage brokerage prior to me joining, so they started the company before I came, and then they were looking to hire someone to really lead the company, and really someone that had experience in lending and experience in real estate and was willing to take the company and build it. And so they offered me the opportunity, knowing myself as a student and having seen me speak on the topic. They knew I was at least relatively competent on it.
Yeah.
And yeah, they offered it. I took a couple weeks to think about it, and I said, let's do it.
That's awesome. That's awesome. So taking the leap of being a partner instead of a employee, which is essentially graduate from the jobs to that entrepreneurship. Um, and you mentioned about you also invest in single family before. How many doors were you investing in single family before you wanted to go bigger, and why so?
So I had bought 3 single family, and I wanted to go bigger. I love how people say, like, the economies of scale, and all that's true, but the
Yeah.
bigger you go, the more money you make. That's the truth of it. Yeah, I mean, I bought 3 single family. They were doing quite well. I was self-managing all of them. I still do today, and just wanted to go bigger to make more money.
That's awesome. And so now switching gear a little bit, can you tell us a little bit about the multifamily? Like when you talk about the 50 million, like 50K loan to like 8 million, $20 million loans, um, when you're working for the mortgage company, is there any differences kind of between that? What's the biggest difference you noticed when you underwriting these loans? Yeah,
Yeah, so it's
that's a
it's
loaded question. There's a
yeah,
gazillion.
it's a lot. I would say, for what I do now with the mortgage brokerage, we broker debt on multifamily for loans $1 million or higher.
Uh-huh.
So um, if you're looking for a certain type of debt, there's tons of different types of debt out there, and the size of the loan will impact that. But just to keep it easy, let's say you're doing a kind of a stabilized multifamily property. Most people want to go to a bank or go to Fannie and Freddie, or CMBS. There might be some options there, but because a lot of times the larger loans are considered less risk in the eyes of the lender, and the reason for that is they can take a larger vacancy hit, they can take a larger delinquency hit. So a 200 unit property, 50 people have to move out, maybe not 50, but 20, 25 people have to move out before it really starts hurting the income. Whereas a 10 unit property, 5 people could move out and you're 50%
Right.
vacant. So lending on multifamily properties, the larger the loan, generally the better terms you'll get, just because it's seen as less risk in the eyes of the lender. And we've seen it all throughout COVID. So in 2020, 75% of Freddie Mac's loans that were in forbearance were all under $6 million. So the majority of loans that had issues were smaller loans. So um, the biggest difference in loan size in terms of the underwriting is these smaller loans are going to be higher interest rates. They're going to be a little bit more restrictive on the underwriting. They're going to be a little bit more analytical in terms of the guarantors and things like that. And on the larger stuff, not that it's a piece of cake because there's still qualifications, but
Right.
they're more excited about doing larger loans because there's less risk in their eyes, and the lender makes more money, so that helps too.
Yeah, absolutely. Because we noticed, because in Phoenix we focus on smaller apartments, so they're
Mhm.
usually sub $5 million loans. And of course we have connections and they get done. there's a lot more restrictions in terms of how much GP needs to put down, and etc. Um, and when we get our, deals in Texas, which is generally really large, $30 million acquisitions, and we get lenders just kind of chase us down the street, trying to compete for giving us a term sheet. Whereas like the smaller loans, it seems like it's just a few players that we have deep connections to. We usually just send to them. Yeah, so I can definitely attest there's a difference there. Now, interestingly, where do you see the interest rate is going? That's, I'm sure everybody when we get a banker on the
All
show,
right.
everybody's
Oh,
always interested on these market updates in terms of like where do you think the interest rate is going um, for the
mhm.
foreseeable future? Yeah.
So I'm going to try. I haven't really answered this on a recorded line, so I'm going to try and give a long-winded answer and see if I can uh, prove my credibility in some way. So different rates are based off different metrics. So the Fannie and Freddie base their debt off of the treasuries, so the 10-year treasury, and the 10-year treasuries are based off supply and demand for bonds. So, for example, if there's a lack of demand for bonds, the interest rates will go up because they have to offer a higher yield in order to um, draw in more demand for those bonds. So right now, what we're seeing is that less people are interested in bonds because they don't provide a very high yield and they think they can find more yield in the market. So people are not as excited about bonds for 10-year bonds and they're taking that money and they're putting it into the market. Um, and so that's why we're seeing interest rates start to rise is because people are not excited about buying bonds. And so therefore the demand for bonds is low. And so they have to promise a higher yield. In retrospect, in 2020, when the economy crashed, people did not want to put money into the market because there was a lot of risk in the market. So they all put it into bonds because that's considered risk free. And so that's why the bond rates dropped because there was so much demand that the bond market does not have to present a high yield. So
Gotcha.
that's the Fannie and Freddie. And banks, they will reflect their pricing based off of the bond markets, but the majority of banks base their pricing directly off the federal funds rate, which is controlled by the Fed or the federal discount rate. So
Gotcha.
the Fed has much more control over a bank rate than it does over the Fannie and Freddie's rates.
Gotcha.
There's a difference between what's going to happen with Fannie and Freddie rates, what's going to happen with bank rates, and that's because Fannie and Freddie's is tied to the bond market, which is based off supply and demand,
Right.
and the banks are controlled by the federal funds rate, which is directly controlled by the Fed. So there's a little bit more control with the banks, which is why Fannie and Freddie is actually being outpriced by banks right now because the federal funds rate is still zero and the 10-year treasury is 1.6. It had shot up. So I think this is my prediction. I think
Responsible for this. And everybody else, like it's hard to predict economy. I'm just gonna put the disclaimer out there.
oh yeah,
So whatever well projected is just his personal opinion.
that's
Uh,
right. I think that, and you're right. The point, like, I will, I'll preface my prediction that I'll probably be wrong, but I think the economy is starting to do better, and people are taking money out of bonds, putting into the market because they think that they can make a higher return there, and I think because of that, over the rest of this year, we'll probably see interest rates just continue to slightly tick up. Maybe we see the 10-year treasury go up to 2%. Maybe we see it stay where it's at now and lenders increase their spread a little bit. So I think within the next 6 to 8 months, we'll see interest rates slightly tick up
mhm.
and we will probably see inflation tick up as well, just as the economy continues to improve and more stimulus goes into the market. I think we'll probably see inflation tick up as well. I think the Fed will keep rates low until we see inflation over 3% or more until they really start getting worried. I do think Powell's got the stomach to keep rates low, even in the eyes of inflation. And then in 2022, I think that the economy will slow down a bit. I think inflation will slow down a bit. I think the true unemployment that we're seeing now will really start to show face. I don't think the economy will be as strong as most people think. And then we'll see the economy kind of taper off a little bit, and then the rates will come back down. So I think rates will go up a little bit and then they'll come back down. That's what I'm thinking. That's what I'm advising my clients. And that's a lot of research that's gone into it, but you never know.
That has to do with the government's pumping the cash back into the economy and how they sustain all these forbearance program, which right now it's being just kicking down the road a little bit more um, because the government's kind of pumping in money for saving people who are would otherwise foreclose their homes and etc. And then, so where do you see how this relationships that you just analyzed over that has an impact to the investment market for multifamily specifically?
I think it's great. I think multifamily we're seeing cash flows, returns decrease, but you're seeing cash flow returns decrease everywhere. I mean, almost every single investment that's out there, you're seeing cash on cash returns decline. I mean, as interest rates go low and lower, debt becomes cheaper and cheaper. So asset valuations become higher and higher. And the higher the asset valuation, the harder it is for something to produce cash flow. So you're seeing that everywhere because of the decrease in interest rates. So multifamilies cash on cash returns are lower and they're probably going to stay low. But we're in an environment where the value of the dollar is being destroyed. There's a lot of other risky investment types that are not as safe, that compared to multifamily. So multifamily is a hedge against inflation, which the value of the dollar is being destroyed. It still does produce cash flow, and if there's more and more money that's realizing this, so they're putting more and more money into it. So the valuations are going to continue to go up. Is there risks? Absolutely. But in terms of a risk-adjusted return, I think multifamily is a phenomenal place to be. And depending on the strength of the economy, I do think we'll probably see a couple of years where it's not as good, or we see some sort of decline in values and cap rates and cash flow. But it's still a phenomenal place to put money. I mean, we're closing on an 85 unit deal here soon, and every single dollar I can put towards it, I'm putting towards it.
Yeah, that's awesome. That's awesome. And it because also multifamily, I'm guessing residents, people who may be losing their single families will also need to probably find a place to live. Uh,
Hmm.
in terms of that, and also, there may be a slowdown. Have you seen kind of like a slowdown in the markets with 2020, the construction slowdown? Potentially happening through all the markets, which could potentially create a shortage of housing in the multifamily space, where
Absolutely.
families, it's a little bit more on hinges over there. Single family also have a volume slowdown as well, I think. So probably creating that. And then in terms of the loan, I know I'm gonna because I have a mortgage broker on the show, so we're gonna be asking a lot of mortgage.
Please, no, that's what I love. So
Yeah. And so can you explain to us about different types of loans, such as like bridge loan, bank loans, and agency loan? You just kind of explained to me on the agency and the bank loan, which actually, by doing so many business in this market, I have no idea what, agency loan was actually based on the bonds for some reason. And now it makes all sense. Why does that not going up or down consistently with a bank loan? But can you tell us a little bit more about bridge loan market? What do you see bridge loan market, and what is bridge loan? Just explain to our viewer. And then that as a alternative in the next 1 or 2 years to be a finance possibility for value add projects.
yeah, I think there's probably three main types of loans in multifamily. There's the bank loan. So I like to, so people who aren't watching it might be difficult, but there's the bank loan, there's the bridge loan, and then there's agency.
Right.
So the they each serve a different purpose. So think of the bank loan is for maybe a newer sponsor or someone who's trying to reposition an asset. It's maybe a light value add deal or potentially a heavy value add deal. The bridge loan is a value add or a heavy value add. The bridge term comes from bridging a property from unstabilized to stabilized. So it's literally a bridge from a poor property to a good property. And then agency, which is Fannie Mae and Freddie Mac, are two government agencies. And that's much more for a stabilized product. So something that's occupied, it's already at kind of at market, and it's just chugging along. So the bank loan, this is your local bank. This is credit unions as well. You drive down the street, you see them all over the place. There, you've probably got billboards in your city with the face of the banker. Uh, so this bank is generally, if you're going to start out, this is where most investors will start with. Let's say maybe you're doing a 10 unit. This is the bank that they get their funds from their deposits. So you go and put deposits at their bank, and they use that and they lend it out. Generally, the right now the terms are roughly 70 to 75% loan to value, 4% interest rate. It's a 5-year term, a 25-year amortization. The big benefit for banks like this is, let's say the property's 70% occupied, and you're going to go in and you're going to fix it up and get it to 90. A bank will be okay with a maybe a not fully occupied property, and they'll be willing to take a risk on you a little bit more than the bridge or the agency will. So this is why it's a good option for someone who's starting out. And then bridge loan is really a property that needs a lot of work, that needs hundreds of $1,000s worth of rehab. And so the bridge loan is willing to include the rehab into the loan. So we did a deal recently. It was a 20 unit in Georgia, and they were able to finance a 75% of the purchase price and then 90% of the rehab. So they had to 80% total loan to cost. They had to come out of pocket very little in terms of the full the rehab dollars and things like that. And so they take those loan dollars, they use it to fix up the property, and then they refinance. So this is it's a riskier loan. It's generally 75 to 80% loan to cost. The interest rates will range depending on the loan size. They can be anywhere from 4 to 7%, and it's generally a 2 to 3 year term, interest only. So that's the bridge, and then the last is agency, which is Fannie and Freddie. And again, this is for a stabilized property. This is for more experienced sponsors. This is a very low risk type property, and they're generally they can go up to 80% loan to value. Interest rates right now are probably just north of 4%. If you go into the larger stuff, it can be under 4%. You can do a 10-year term, 15-year term. And one of the huge benefits to this is it's a 30-year amortization. So you can really push out that cash flow, and it's non-recourse as well. So you're not personally liable for the debt.
Yeah.
So those are really the main three.
That's a big one, the recourse versus non-recourse. If you can kind of like explain that a little bit for our viewer, it would be great as well.
Yeah. So recourse means that you are personally liable for the debt. So let's say it's a $1 million loan, and you bought the property for 1.2, and for some reason the market tanks or whatever happens, major employer in that city leaves, and the bank has to foreclose on the property. If they then go and sell the property, but they can only sell it for 600,000, you as an individual will have to pay the remaining $400,000. And if you don't have $400,000, they can go after your personal assets. So they can go after your stocks, they can go after your cash, they can go after any investment properties you have. If you have a business, they can go after all of these things. If it's non-recourse, basically they foreclose on the property, they still take the property, but you're not liable for any remaining balance.
Right. That so the recourse has a lot more risk of going bankrupt for an individual, versus a non-recourse loan, which is kind of just capped around the building itself, per se. And but I know, like, after hearing this for the first time, some of you would be like, "Wow, I want to get non-recourse loan." But there is, like you mentioned before, there is a loan size limitations on, what possibly you could get non-recourse, because some banks also offer non-recourse, right? But
Mhm.
likely not on their first time clients and this and that. So can you kind of tell us a little bit more about that? Even though, yeah, this is really nice, but when someone who's considering getting into multifamily space, either thinking about doing a smaller multifamily by their own or partner up to do a bigger, larger apartments, kind of like the pros and cons, and when it comes to recourse, non-recourse loan, that would be great if you can
Yeah.
talk about
So
that.
yeah, most people starting out 95, 99% of the time, you're going to get a full 100% recourse loan. I mean, that just kind of is what it is. Um, the and I wouldn't be too afraid of that. I mean, really, the investment properties I own are on recourse. A lot of the deals that we do, they're on recourse. You have to feel very confident in the deal you're buying, because if you're not willing to do recourse, that means you know you, maybe you shouldn't be buying that property.
Right.
Um, but yeah, it just definitely don't be afraid of recourse. But if you're starting out, chances are a bank will do recourse. Once you become a repeat customer of theirs, um, once they feel comfortable with you, they might be willing to do things like a non-recourse burnout. So after, maybe after year one, they'll do 25% of the recourse burns off, and then after year two, it's 50%. So you can structure it like that if you are very um, recourse averse. But yeah, the majority of the time starting out, it will be recourse. The good news is the other two options, bridge and agency, they are most of the time non-recourse options. And sorry, I've got a dog walking by. I don't know if you can hear it. But uh, once you get into your second, third deal, non-recourse becomes much more available. And if look, if you really want non-recourse in the first deal, just partner with someone who's quite experienced, and you could very easily get non-recourse. So that's an option too.
Yeah, that's awesome because partnering up is always an option over there. Now, interestingly, the less known items are CMBS loans, and then the what was the other one? The HUD loans.
Hmm.
Can you tell us a little bit more about the CMDS loan and how is evaluated different than agency loans? And then some pros and cons of it in this economy environment to have a CMDS loan.
Yeah, so a CMBS loan stands for commercial mortgage-backed security. And what these guys do is these are lenders that will lend out individual loans, and then they will package them together and sell them off as a commercial mortgage-backed security. So it's a security that is sold as hundreds of loans, all as one package. And I guess one of the main differences, this is a private market. Whereas Fannie and Freddie are controlled by the government, yeah, at least to an extent. And CMBS is these are board members, these are individuals making decisions, and normally they're pretty similar. Like it, this is why it's important to work with a mortgage broker,
Right.
is because these all their terms will change, their appetites will change in different market environments. Different loan products are more enticing. Where 2019 CMBS was not as aggressive on the leverage point, whereas Fannie and Freddie were much more aggressive. But then there was a period where Fannie and Freddie hit their lending caps, so CMBS was actually much more competitive in that time frame. Um, and then, for
What is
example,
the
right
lending
now,
cap? If you can help kind of explain.
yeah, yeah, lending cap is they have a limit that they can lend per year. And so I think it was 2018, they hit their lending cap at like September, and so they're like, we're going to run out of money. So they pulled back almost all of their lending, and how they pull back is they increase their interest rates by a lot. And so a lot of loans at that period had to switch to CMBS loans very quickly in order to close their deals.
Hmm.
Um, and for example, right now, CMBS is not requiring P&I reserves, whereas Fannie and Freddie have 12 to 18 months, potentially less, depending on the loan size, whereas CMBS um, is offering very similar terms with no P&I reserve. So each different market is going to have a different competitive nature to it, and that's kind of some of the differences there.
Gotcha, gotcha. That's good to know. And then the CMDS is based on what they call a swap, right? What is a swap versus LIBOR versus Federal Reserve rate?
I'm terrible explaining the swap. You're gonna catch me on the spot there.
Yeah,
Um, I don't even think I could provide a great answer. This is one of those that I've been explained 4 or 5 times, and it still kind of confuses me.
yeah.
But I believe it is you. And if you know it better than you might be able
I
to
do
explain.
not. That is
Okay.
the honest question. Yes.
What's
It's
sad is
okay. We can edit
no,
this
no, no, no,
question.
no. I'm
Yeah.
gonna try and answer it.
Okay.
What's sad is it is relatively simple. It's just not common, so I don't work with it a ton. But I think it is basically you lock in an interest rate, and you have the option to, or the lender has the option to swap it out at some point, and so that they're willing to do a certain type of interest rate, knowing that they have the ability to swap it, or that you have the ability to swap it. So someone else could, the next banker you have, ask them that question. I'm sure they'll give a much better
How about
answer.
this? We'll put this in the show notes and we'll do some research on the swap and then getting back on this.
Yeah,
Uh
we'll
on this.
both learn from it.
Yes, we'll put the research on this. And the LIBOR is just simply it's based off a British system versus our U.S. federal rate.
Yeah, it's the London International Bank of Rates or something like that, and it's the rate that all the banks in Europe, I believe, lend to each other. So it's similar to the federal funds rate. Yeah.
Gotcha. Okay, so one other products we have question about is the HUD.
Mm.
So tell us about people, like what type of people will be able to qualify for it even, and what size of a product it would be, and what's the benefit and the pros and cons of having a HUD loan versus regular agency loans.
Yeah, so Fannie and Freddie are like quasi government agencies, whereas HUD is direct government loan. And it's the best possible terms you can get. I mean, even better than Fannie and Freddie. But the downside is it's a beast. So this is for very low risk. This is for stabilized deals. This is a you're going to buy this property and hold on to it for 10 years or never sell it. So the pros are the terms. So you can get the interest rates right now are in like 2.7 compared to agency, which is like 4%. So the interest rates are crazy low. You can do a 35-year term, meaning it won't mature within 35 years. You can do 35-year amortization. So it's a lower payment. Um, the terms are really unbeatable. The type of deal this would be for, generally the loan needs to be at least 4 million or more. And then again, this is a stabilized deal. This is a quality condition asset. This is a something that is very low risk. It's in a good area. It's got a strong historical occupancy and operating statement, and that you'll hold on to for a long period of time. This is a generational wealth type asset that you're going to try and pass on down to your kids. And the downside is the government does not lend this type of debt easily. So it's going to go through a long qualification period. It probably takes anywhere from 4 to 8 months to close a HUD loan. But I know multiple people that are doing refinances with HUD and construction loans with HUD, and they love the terms, and it's a property that they're going to hold on to forever, so they're okay with it.
Yeah, so refinance is probably a better strategy to even get into a HUD, and then the plan is to kind of hold on longer. So this
Yep.
actually leads to our last question around the loans. I know like most times we interview people about their personal story, but I just can't help it with you on here to
I'm
give
pretty
us all
bland, I
this knowledge
promise.
on the mortgages. Tell us a little bit about yield maintenance and
Hmm,
like the prepayment penalties, because one thing that I want to kind of highlight is as a part of the investment. I think a lot of people only think about acquisition and they don't think about their exit strategy. So with the unpredictability of the market, but sometimes if you understand it a little bit more, you're going to be able to kind of better hedge your bets if you have a certain type of exit strategy. So tell us a little bit about that yield maintenance, the prepayment penalties, and how that work with agencies, bank loans and like bridge loans, and where you see like there's a beneficial for a certain type of investment versus not. Yeah.
sure. So yield maintenance so a prepayment penalty to begin with is if you're going to prepay the loan, meaning pay off the entire balance of the loan before the term ends. So if it's a 5-year loan, if you're going to pay it off at the end of year 2, the lender will generally charge you a fee for prepaying your loan in order to make up for the interest that they would have earned on the loan on the interest down the road. So again, Fannie and Freddie generally like to lend on stabilized long-term assets. And so in their eyes, they do not want you to prepay this loan. So this is why they have a more expensive prepayment penalty, so that it costs you more to prepay the loan. So they have two types of prepayment. I guess there's defeasance as well, but for now we'll stick with yield maintenance and step down. Yield maintenance it's a complicated calculation. In short, it's expensive. if 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 you plan on prepaying your loan in 2 to 3 years, I would not recommend going with yield maintenance. But the best way that you can kind of summarize what yield maintenance is the interest that the lender would have earned for the rest of the loan. They're going to charge you that. And if you've ever looked at an amortization schedule and see how much interest a lender makes on a loan, it's sad. It's a
Oh, it's
lot.
double. Yeah.
Yeah. um, I did that recently on one of my houses. I was like, Jesus. Um, but so the yield maintenance is a pretty hefty fee.
But it
Um,
changes, right? It changes based on the current rate. So how does that work? Yeah.
yeah. So the calculation is I've written an article about this. It's online. I can't remember exactly the calculation of it,
We will
but
put that link on the show notes as well because Will's gonna provide us the link and then we'll
yeah, yeah.
yeah.
I'm trying to think if I can remember it. It's the your current loan balance, the net present value of your current loan balance multiplied by the current interest rate on the loan subtracted by the market interest rate. So it's the net present value of the loan multiplied by your current interest rate subtracted by the market rate. So the calculation includes a variable rate. So as the market rate changes, the calculation will change. And the way to think about it is if rates go down, your yield maintenance cost is going to go up. If rates go up, your yield maintenance cost is going to go down. So if let's say you lock in a rate right now at 3% and rates go to 5%, it's going to be less for you to prepay your yield maintenance expense. It's still going to be a decent amount, but if you're at 5% interest rate, and this is what we've seen over the past couple of years, if you lock it in at 5% and the rates go to 3, your yield maintenance is going to hurt a lot.
Mhm,
So
mhm,
um, that's the calculation, and that's why it can change depending on the market rate.
Yeah, definitely. And now what are some options within the agency area? So first of all, bridge usually don't have prepayment penalty because the product is designed for short-term holding, and short-term holding and refinance. And then the local banks usually typically don't have prepayment, right? It's kind of like probably a mixed bag.
Hmm.
So that's something that people should read about. But agency is the one that usually have the yield maintenance. But what are some options to potentially, like avoid the yield maintenance? Is there even options to avoid the yield maintenance?
There is. So that's where you can convert from a yield maintenance to a step down. And what they do, so the step down is, let's say it's a 5-year loan. In year one, it's a 5% prepayment penalty fee. In year two, it's a 4%. In year three, it's a 3. So 5, 4, 3, 2, 1. There's different options for this. There's even one that is a 3-1-0. So you can do a 5-year term loan with a 3-1-0. So in year three, you've got no fee to prepay. And what they'll do is they'll increase the interest rate around 20 to 40 bips. So if you're at a 3% at a yield maintenance and you want to do a step down, the rate might be 3.25 for a 5, 4, 3, 2, 1 or something like that. So that's why it's important to know what your business plan is and then draft the terms of the loan around that. Because a lot of people just go in trying to get the best rate, and they don't, they don't voice to their lender that they want to refi down the road, and they don't plan for that, and you can't put yourself in a bad position.
Yeah, that's correct. And then there's also something called a Freddie floater.
Hmm.
You explain about that a little bit more. And then would you like among these different types of products, given the interest rate is kind of lowest right now, it's going up a little bit, but it's pretty much historical pretty low. What kind of product would you say, if all equal, because everybody's qualification is different, depends on the deal size, which loan would you recommend people to have?
Yeah, so the loan that I would recommend is solely going to depend on your business plan.
Right.
So it's impossible to give a blanket loan because if you want to buy, fix it up, and sell, a floater is perfect. Um, if you have a property you want to hold on for 10 years, a floater is not perfect. If you've got a property that you're not sure what you're going to do, maybe it makes sense to go on a 7-year term fixed rate loan. So it's going to the advice I would give is it's going to solely depend on the property type in your business plan. But a Freddie floater is all these. So the bank loan is fixed, the bridge loan is floating, agency is fixed. But Freddie Mac conventional, so loans that are 6 million or higher, they do offer a Freddie conventional or a Freddie floater, which means that it's a floating interest rate, but there's no prepayment penalty, or it's a 1% prepayment penalty. So it's a very, very minimal prepayment. So if you're going to buy a deal, you're going to fix it up, you're going to raise rents, and you don't want to go bridge, and you don't want to go bank because you want non-recourse, and you want the flexibility on the prepay side, you want to be able to refinance or sell within 2 years without having to pay a large prepay. The Freddie floater is perfect. Like we quoted a deal recently where I personally would not have wanted to do a Freddie conventional or a Freddie floater, but the investor, he owned 15,000 units. He knows way more than I do. He was willing. He wanted to do a Freddie floater, and I even advised against it, and he decided to go with the Freddie floater just because he knew he was going to refinance or sell within a couple of years, and he was okay taking on the interest rate risk. So it's very dependent on the deal, but the Freddie floater provides much more flexibility on the prepay, but it comes with a little bit more interest rate risk. So it just depends.
Gotcha, gotcha. Awesome. All right. Well, I have to grill Will on the more detail here. I think we should have you back on some of our live webinar sessions,
Yeah, I would love to.
and just give people some market updates, a little bit more specific into the details here. But well, last question is, where do you go from here? Where do you see like taking rent capital to, the next level, and where do you kind of see yourself in like 5 years?
Yeah, so I mean, our goal this year, I'm very transparent with revenue and things like that. Our goal is to do 30 million in loans. We're set to do 15 million in by May, so we're on track. So the goal would be 30 million. The long-term goal of Rand Capital is to do $1 billion in loans a year. That's a long ways away, but right now it's a small team, so I think um, by the end of the year, we'll look to hire another loan originator and really be pretty dominant in the Southeast. and yeah, just slowly expand. Business is, it's a marathon. It's not a sprint. And so you just take it one day at a time and do all the little things the right way.
Yeah. And then after you're taking all these active incomes, where are you putting them?
Oh, I was mentioning this to my underwriter today. I cannot hold on to cash. I invest everything. I I I'm I I put a lot in the stock market. I put most of my money into real estate, and I'm pretty bullish on crypto and DeFi. So I put a lot towards that recently. But I do have a problem holding on to cash. I invest everything.
Hey, that's actually much better way. Who wants to hold on to cash if inflation is just gonna get them devalued, right?
That's
So
right.
it's
Yeah.
better to invest them. Well, thank you so much, Will, for the show. I know it went through not quite conventionally how we unveil the stories over here. We may have you coming back. Tell us a little bit about what does it take to open a bank and all that stuff, or open a lending entity and etc.
Sure.
But this is a tons of information and packed today. Thank you so much for your time, and we'll see you next time, maybe.
Yeah. Thanks for having me. Love to come back.